One of the very first things you learn as a beginner investor is not to chase high yields, and it's true that there are stocks with high yields that are quite risky and likely to cut their dividend in the future, but high yield does not always equal high risk. In reality, a stock or fund's dividend yield tells us absolutely nothing about the sustainability of the dividend, it's the underlying fundamentals. Now, I built a spreadsheet that lists the details of every stock in the S&P 500 that pays a dividend, which you can download for free at the link in the description, but the reality is that there are only 11 stocks with a yield of over 6% in the S&P 500. If you're someone looking for high yield, that's not good news. The average investor has no idea just how many high yield opportunities are out there, but they don't know where to find them, and they certainly don't know how to analyze them or the dividend sustainability. Now, there are typically 5 main asset classes that have higher yields. We have covered call ETFs, MLPs, which is master limited partnerships, REITs, which is real estate investment trusts, BDCs, business development companies, and then we have preferred shares. Each one of these asset classes is wildly different from the others. And because of that, the way that we analyze them, the way we analyze the sustainability of their dividends is quite different. So in this video, we're going to be analyzing how to analyze the dividend sustainability of each of these asset classes and looking at real examples for each of these stocks/funds. So let's go ahead and get started with covered call ETFs. Now, covered call ETFs are really growing in popularity. There's probably a few different ETF issuers that you've heard of. For example, we have YieldMax, that's a popular one. We have JP Morgan, their funds like JEPI. We have Global X, which offers one of the oldest covered call ETFs in QYLD. And then we have NEOS, for example, QQQI. In fact, over on Dividendology.com, I've been building out a database for each of the asset classes that we're looking at today, and you've probably already seen a little bit of the covered call ETF database that I've been building out. Now, this is just the beta version. I'm adding more really important information to each of the funds on this sheet. Right now, you can download this sheet for free at the link in the description. Now, covered call ETFs have quite high starting yields, and so the big question is, are those dividend payouts sustainable? And unfortunately, I think there's a lot of people making massive mistakes buying covered call ETFs with unsustainable dividend payouts. So how do we analyze these funds? Well, in my opinion, it really comes down to 3 main things. We want to pay attention to NAV, which is net asset value, the portfolio options coverage, and then the option moneyness. I think unfortunately for a lot of people buying these covered call ETFs, they probably don't even know where the funds they're buying fall into with these categories. But again, the Dividendology database over on Dividendology.com is going to solve this problem. Right now, with the database, we have 2 of these listed. We have options moneyness and we have portfolio options coverage. What is it that we want to look for? Well, let's start with options moneyness. Now, options moneyness, it typically boils down to around 3 things. We have at the money calls, in the money calls, and out of the money calls. And we have to understand how each of these works. At the money calls typically have higher premiums but caps almost all the upside. In the money calls has the highest premium but sacrifices upside completely. And then out of the money calls have slightly lower premiums but allows more of the upside, and because of this, they're better in bullish markets. We'll come back to the sustainability of these here in just a moment, but let's talk about portfolio options coverage. Now you can see I have details on all the funds and their portfolio options coverage, and this is really important because this is telling us the percentage of a portfolio's holdings that are covered by options. Now remember, covered calls limit your upside. So a lower portfolio options coverage means that the fund has more upside. So what do these 2 things have to do with dividend sustainability? Well, they're both highly correlated with net asset value. Over the long term, covered call ETF's ability to continue to make dividend payments depends on the net asset value. The problem is that many high yield ETFs are slowly liquidating themselves, so here's why this is so dangerous. If they have a shrinking net asset value, this means fewer assets to write call options, leading to lower premiums, leading to lower dividend payouts. So a lower portfolio options coverage ratio helps the fund continue to grow net asset value, and over the long term, typically out of the money calls is going to help a fund grow their net asset value. One of the things I'm adding to the database over on Dividendology.com is whether or not each of these funds has grown net asset value since its inception. And out of around the 65 covered call ETFs we have listed in the database, less than 40% have actually grown their net asset value since inception. That is a huge red flag. There's a lot of bad covered call ETFs out there. And unfortunately, most websites don't give you information as to whether or not a fund is growing net asset value. This isn't something Seeking Alpha tells you. It's not something that Yahoo Finance tells you. In fact, the only website where I could find accurate information on this is YCharts, and their lowest subscription is $3,000 a year. This is one of the many reasons that I'm adding this information over on the Dividendology database. It's going to help investors make much more informed decisions. So let's check out our example, QQQI. Again, the main thing we want to look for is net asset value. If we jump over to NEOS's website, this is one of the few funds that actually list off how the net asset value has changed since inception for their fund. And what we can see is since inception, net asset value for QQQI has actually grown quite nicely. It even recovered from the 2025 lows when we had the tariff sell-off. This is a great sign for their dividend sustainability. And as a result, if we jump over to Seeking Alpha and take a look at that dividend history for QQQI, what you notice is those dividend payouts are actually pretty stable. This is certainly not the case for most covered call ETFs. For example, if we look at the dividend payouts from QYLD and look at their dividend history, it can fluctuate quite a bit any given month. One month it was 21 cents, and then in the most recent month it was only 17 cents. Look at the exact same thing for JEPI, another popular one from JP Morgan. If we look at the dividend history for this fund, there is a lot of fluctuation in their dividend payouts, with the lowest being around 26 cents and their highest being around 62 cents. That is a massive fluctuation. And as of late, those dividend payouts have actually been a little bit lower. So again, covered call ETFs are very unique funds, and you have to know what to look for. So far, QQQI has been able to grow their net asset value, meaning those dividend payments look sustainable. Let's keep moving forward and look at master limited partnerships, and these are very different from covered call ETFs. Now, the example we're going to look at is going to be MPLX. Now, there's not many stocks like MPLX. Let me show what I mean. If we jump over to the dividend breakdown sheet and plug in MPLX, thanks to ticker data, the data will load in. Like always, you can download any of these spreadsheets and get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet by going over to tickerdata.com. But we can see MPLX is a high yielder. The yield is around 7.52%. And historically, they've done a great job of growing that dividend over time. It looks like in 2021, they even paid out a special dividend. So that 10-year dividend CAGR is around 8.5%. So a 7.5% starting yield combined with a 10-year dividend CAGR of around 8.5%. That is absolutely phenomenal. You're truly getting the best of both worlds with a high starting dividend yield and dividend growth. But will that dividend growth be sustainable moving forward? Or is that dividend even sustainable at all moving forward? What are the things we should be looking for? Well, in this scenario, we don't necessarily look at the payout ratio. We don't look at the free cash flow payout ratio. What should we be looking at? Well, what we pay close attention to is the distributable cash flow coverage ratio, a term you might not have heard of before. So let's dig into this for MPLX. What we'll be able to see is that their distributable cash flow ratio is sitting at 1.5x. What does this mean? Well, it means the distribution, in other words, the dividend, is well covered by distributable cash flow. They can make the payment over 1.5 times. This is generally considered quite healthy. In general, when we're looking at this, we want to see at least greater than 1.2 times for these MLPs. Anything lower than this, and especially lower than 1 times, is a major red flag that they're paying more than they can generate. So obviously, we want to see distributions being well covered by distributable cash flow, but we also want the distributable cash flow to be growing so that they can grow those dividends over time. And what we can see from MPLX is that the distribution growth profile is quite impressive. In fact, analysts are forecasting over a 10% compounded annual growth rate through 2027. This is why MPLX is so impressive right now. And this is the type of stock that most investors don't know about. A stock yielding above 7% with the potential to grow that dividend at above 10%. That's pretty mind-blowing that there's opportunities out there like that. But again, you have to know where to look and you have to know how to analyze the dividend sustainability, or you might get caught in a dividend trap. Now we come to REITs, and you're probably more familiar with a few different REITs. For example, you've probably heard of REITs like Realty Income Corporation, the monthly dividend stock. We have VICI Properties, which is a relatively large size in my personal portfolio, but the one we're going to use as an example is Alexandria Real Estate Equities, a REIT that's down about 38% now in the last year, and it has a relatively high starting dividend yield sitting at about 6.64%. So what do we need to be looking at when it comes to REITs? And this is where a lot of people make a major mistake, just like these other asset classes. If we jump over here to Seeking Alpha, again, payout ratio. This is what most people are familiar with, but if we look at the payout ratio for Alexandria Real Estate Equities, we're looking at about 700%. And if we look at it non-GAAP, it's about 178%. But fortunately, this isn't what we need to be paying attention to. When it comes to REITs, what we want to pay attention to is not the payout ratio, it's not the free cash flow payout ratio, it's the AFFO payout ratio, which stands for Adjusted Funds from Operations. Now, when it comes to REITs, AFFO is kind of the equivalent of free cash flow. So the AFFO payout ratio is going to be your dividend per share divided by AFFO per share. So here's what we're looking for. Less than 80% is generally considered safe. 80 to 90% can still be acceptable in the right circumstances, but once we start getting higher than 90%, that's a little bit too risky for my liking for the most part. But when we look at Alexandria Real Estate Equities and scroll down and look at that forward-looking AFFO payout ratio, it's sitting at about 74.05% forward-looking, and for the trailing 12 months, about 74.47%. So it falls within that somewhat healthy range. Now, on top of this, we want to check about the sustainability of the tenants in their portfolio, look at things like credit ratings, and also make sure we understand the lease structures. Now, one of the things you'll notice when we look at this payout ratio, we're looking at dividends on a per share basis and AFFO on a per share basis as well. Why is this so important? Well, let's look at another example. We have to understand REITs are required by law to pay out 90% of their earnings in the form of dividends. So let's look at an example with Vici Properties. Thanks to ticker data, the data will load in, and I want to pay close attention to shares outstanding. Now, because REITs are required by law to pay out 90% of their earnings in the form of dividends, they typically have two different ways that they can raise capital. One, obviously, they can take on debt. This is what most stocks tend to do, but also they can issue new shares. Now, which one is actually better depends on really the macroeconomic environment we're operating in, what the balance sheet of the company looks like, and a few different other factors. And what we can see in the case of Vici Properties is it looks like for quite a few years, they were issuing new shares, but the main focus was taking on debt. That's because during this time period right here, we were operating in a relatively low interest rate environment, meaning taking on debt was more attractive. But after we started entering a higher interest rate era, we can see they started issuing more shares. Now, because they issue more shares, this is why we want to pay close attention to adjusted funds from operations on a per share basis. So in the case of Alexandria Real Estate Equities, let's do exactly that. If we jump over to the income statement and scroll all the way down, we should be able to find it. And we can see right here, we do have adjusted funds from operations, which is growing every year, but we have to look at it on a per share basis because that could dilute it. So we'll come down here and we can see it on a per share basis now, and this is a good sign. We can see even when we look at this on a per share basis, it's still growing every single year. This is a really good sign, and really this is exactly what we want to see. If a REIT's able to grow AFFO on a per share basis every single year, then you can pretty much expect that dividend to grow as well on a per share basis also. So in the case of ARE, we're now talking about a REIT that's yielding around 6.64% and historically has a dividend growth rate of above 5%. Now we again come to one of the groups that I think is more interesting. There's a lot of opportunities here because a lot of people don't take the time to dig into them, and that's business development companies. Now, a lot of the times these companies have very high starting dividend yields and will pay out dividends on a monthly basis. And the most popular BDC out there is going to be Main Street Capital Corporation. It's trading at about $63.57, and in the last year, it's up about 22.74%. And over the past 5 years, it's done really well, up about 110%, and that doesn't even include dividends, which is typically where most of those gains are going to come from. Now, we can see the starting dividend yield for it on a forward-looking basis right now is about 6.77%. Now, before we go any further, it's really important we actually understand how these BDCs operate, how they make money. Basically, a BDC generates income by lending to small to mid-sized private businesses at high interest rates and collecting interest income, fees, and occasionally equity stakes in return. If we jump over to Main's investor presentation, they basically state that Main is a principal investor in private debt and equity, so their long-term focus is on delivering our shareholders sustainable growth in net asset value and recurring dividends per share. Historically speaking, they've done a great job at this because they have never decreased their monthly dividend rate. They have a 132% increase in monthly dividends from 33 cents per share paid in Q4 of 2007 to declared dividends of about 76.5 cents per share in Q3 of 2025. On top of this, they pay special dividends pretty frequently. For example, here we're looking at all the dividends they paid out since around 2008. And in the gray bars here, we can see the monthly dividends are paying out. The green bars are their supplemental dividends. These are special dividends. So when do they get to pay these out? Well, it all depends on the distributable net investment income. When it comes to paying out dividends for BDCs, there's typically two things that we have to look at. To start off, that dividend coverage ratio, which is simply going to be the net investment income divided by the dividends paid out. For BDCs, if it's greater than 1, then that dividend is covered, and if it's less than 1, then it's risky. That's not sustainable for the long term. And based off my research, I found that Maine has a dividend coverage ratio of 1.42. Now, again, it's really unfortunate because it's difficult to find this type of information on most traditional websites like Seeking Alpha, like Yahoo Finance. So again, this is going to be information I'm adding to the Dividendology database here in just a month or two. But we can see Maine has a very sustainable dividend coverage ratio. And because of this, when they see opportunities, they can actually pay out pretty frequent special dividends, and the expectation is that they'll continue to be able to do this. Now, one caveat we have to keep in mind is Main Street Capital and a lot of business development companies in general benefit from rising interest rates due to floating rate debt income. So as interest rates go higher, the net income for Main Street Capital and a lot of business development companies typically increases. And that's what allows them to pay large special dividends. So again, the last few years, we've been in a higher interest rate environment. Those special dividend payments have been quite large. The second thing we have to pay close attention to with business development companies is net asset value per share. Now again, we're paying attention to this on a per share basis for the exact same reasons we pointed out with REITs. We can see BDCs are required by law to pay out 90% of their earnings in the form of dividends, so if we look at those shares outstanding, they're issuing new shares to continue to raise capital to generate more net investment income. So this isn't necessarily a red flag. This is pretty typical for BDCs. It just depends on whether or not they're able to efficiently use the capital they raised by issuing new shares. So obviously, we want to see a growing net asset value per share. It means that the business is actually growing, net income is actually growing, so obviously they can grow those dividends over time. And what we can see on their investors presentation is since 2011, Main Street Capital has been able to grow net asset value by about 149%. In fact, we can see on the 8th slide of their investors presentation, charted out in the dark green is their net asset value per share. So for example, here we can see during the global financial crisis, this did take a little bit of a dip, but they were still able to pay those dividends. And over the long term, they've done a really nice job of growing that net asset value per share. In fact, after the 2020 dip, the growth has been pretty phenomenal. And this is the reason that their returns have been so phenomenal as well. In fact, if we look at the total returns for Main Street Capital since 2020, over the last 5 years, they've way outperformed the S&P 500, which is up around 95-96%, Main Street Capital over 200%. So don't fall for the lie that high-yielding stocks can't see a lot of share price appreciation. And don't fall for the lie that the dividends aren't sustainable. If you know what to look for, there can be massive opportunities. Finally, we come to preferred shares, something that's not talked about very frequently. And I'm not going to lie, in this example, I did cheat a little bit. I'm using PFFA, which is the Virtus InfraCap US Preferred Stock ETF. So it's not technically a preferred stock, but it's an ETF holding a basket of preferred stock. But this is an ETF yielding over 9.51% in the trailing 12 months. No doubt it's a high yielder. And if we look at its total return over the last 5 years, it's about 95%. In the last 3 years, around 33.49%. That's really impressive returns for a stock that's yielding close to 10%. So what do we need to know about preferred stocks, and particularly this preferred stock ETF? Well, typically preferred shares are going to have higher dividend yields compared to common stock, but preferred shares are higher in the capital stack than common stock, but lower than debt. So what does this mean? Basically, if a stock went bankrupt, the debt holders are paid first, then preferred shareholders, then common shareholders. On top of this, preferred stocks generally have less price volatility, but also offer limited upside. So that's preferred shares, but what about PFFA? The fund yields around 10% and has monthly income payouts. It invests primarily in preferred stocks from high-quality issuers, many of which are investment grade, and as an ETF, it provides built-in diversification, which can help reduce the risk of any one issuer defaulting. Now, when it comes to dividend sustainability for preferred shares, it's actually not too different from a typical stock. For example, a stock like maybe JP Morgan would have preferred shares and also common stock. Whether or not the dividend is sustainable for each of those is pretty much the same for the most part. Look for the quality of the underlying business, the credit quality, whether or not the stock is growing earnings and free cash flow. So in regards to PFFA, we could look at the holdings and come down here and see what we think of each of these preferred stocks. You could jump over to their website and dive deeper into their preferred stock ETF fact sheet. So what do you really need to know? Well, there is a whole world of opportunities out there when it comes to high yields, and many of them aren't just sustainable, but they're actually growing those dividends and getting phenomenal total returns. But you absolutely have to know what to look for. You have to know how to check for dividend sustainability. And the reality is, for each of these asset classes, it can be very, very different, which makes it difficult for a lot of investors. And some of the information is extremely hard to find, such as net asset value per share for covered call ETFs, such as data on MLPs and BDCs. Again, this is the exact reason that I'm building the Dividendology database over on Dividendology.com. So go ahead and let me know what you think of some of these high yield opportunities, and be sure to check out some of the free resources at the link in the description. Also, if you want the ability to automatically import stock financials straight into your spreadsheet using the Ticker Data add-on in Google Sheets, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.